afternoon. Welcome to the 2017 Defined Benefit Trend Plan Trend Survey. My name is, actually all participants will be in a listen-only mode throughout the duration of the webinar. You can answer or ask a question at any time using the Q&A function. We will be answering all questions at the end of the webinar. We are recording the webinar and it will be posted to our website as well as a copy of all of the materials. Please visit www.nepc.com. My name is Brad Smith. I'm a partner and the corporate practice team leader. Joining me today are Kelly Regan, who is a senior consultant on the corporate defined benefit team, as well as Kevin Novak. Kevin is a consultant on our healthcare practice. Before we delve into the responses, what I'd like to do is give you a quick update on NEPC. NEPC was founded 31 years ago, and all we do is investment consulting. 100% of our revenue is derived by client retainers. One of the themes you may have seen over the past couple of years is there's been a tremendous amount of consolidation in the investment consulting industry. As the industry continues to evolve, NEPC is committed to remaining a private partnership. Over the past 31 years, we've grown into a firm of 270 employees. We have 32 partners. We now have 8 offices across the U.S. We have 50 dedicated research individuals. As our clients' investment needs continue to become more demanding and more sophisticated, what we've done is we've developed into practice teams. We have 8 unique practice teams. Today you have before you members from the corporate defined benefit and the healthcare practice teams. In addition to those, we also have specialist teams in defined contribution, insurance, public sector, private wealth, endowment and foundation, and Taft-Hartley. We believe that the multi-practice team approach allows us to uncover investment ideas from a very broad spectrum compared to our peers, and we really do believe we provide innovative investment solutions to our clients. We believe a sign of that innovation is just the number of awards we have been honored to receive over the years. One of the things we're particularly proud of is the fact that 11 out of the past 13 years we've ranked in the top 3 of Greenwich. That is a very difficult award to earn every single year, and the consistency of the award is the thing that we're most proud of. So what we're going to do now is we're going to go into the results of the survey. I'm going to start off with a market review and recap what happened since our last trend survey. Then I'm going to turn it over to Kelly, who's going to take you through the trends, and she'll then turn it over to Kevin. As I said before, you will have the opportunity to ask questions throughout the survey. We do have about 30 minutes of prepared commentary, so we will not need the full hour. We did want to provide a high-level overview of the findings of the survey before we get into it. And one of the things that I guess is good news for everybody on today's call is funded ratios have improved during 2017. And a big part of that was really Q4 of 2016. We saw a significant increase in funded status during that quarter as discount rates rose. Although discount rates have come in a little bit in 2017, we've had really strong capital market returns during the year, which has actually helped funded status stay pretty much where they were or just modestly increase. The second thing we've noticed is that plan sponsors have continued to face dynamic challenges. And one of the things that's been really interesting, regardless of whether it's due to the increase in longevity from the continual revisions to the mortality tables, or whether it's downward pressure on forward-looking returns, we've continued to see plan sponsors adapt, review, and modify their glide paths. So they're no longer set it and forget it. Plan sponsors are really continuing to evaluate how they've developed their glide path. The other interesting thing is just the impact of the bipartisan act, the Budget Act of 2015. We're seeing that legislation, which really significantly increased PBGC premiums, is driving a lot of activity by plan sponsors. And Kevin's going to go in detail to tell you exactly what plan sponsors are doing as a result of that. We also see that, unlike our public sector brethren, so to speak, the use of alternative investment strategies, and here it's a big bucket, it's private equity, it's hedge funds, it's real estate. We see that utilization continue to be important to defined benefit corporate plans, and we expect them to remain popular. Finally, one of the things we did ask about in the survey is we wanted to ask plan participants or plan sponsors what their view is on the use of passive investment strategies. So let's step back and take a look and see what has gone on over the past year or so. We issued the survey back in August of 2017, and one of the questions we like to just kind of tease out is, are you a little bit more bearish or bullish on the market over the next 12 months? What's interesting is if we step back and look at where equity markets were during Q4 of 2016, that's the first 5 data points on the bottom of the graph you're seeing right now. You can see that a lot of the equity markets were going down during Q4. That's at a time when discount rates were actually rising. But then take a look at what happened since January 1st. Equity markets have really taken off. And if you look towards the end of the survey, August of 17, that's when the survey was issued. Since back of August of 2016, you can see equity markets are up anywhere from 20 to 28%. I guess we were a little surprised to see that despite the fact that a lot of this growth was due to PE expansion, plan sponsors were surprisingly optimistic about the next 12 months. So let's take a look and see what's happened to discount rates. So the blue line is showing you the current yield on the AA credit, which is a proxy for the discount rates. And I mentioned before just what happened during Q4 of 2016. You can see that the discount rate rose by about 58 basis points during that period of time. Now take a look and see what happened during the balance of 2017. You can actually see the discount rate, represented by the AA, actually came in by about 29 basis points. Despite the fall in the discount rates, we did see some meaningful improvement in funded status. So if you take a look at the blue line, you can see that the average funded status tracked by Milliman. Now Milliman is, in this chart here, is showing you the average funded status of the 100 largest pension funds out there. And you can see that the blue line showed that the funded status improved during Q4 about 7.5%, going from 75 to about 83%. Look at what happened for the balance of 2017. You can basically see that the funded status improved by about 1%. This is at a time when you see the discount rates represented in the green line. You saw a really strong increase in the discount rates during Q4, which was where most of the funded status improvements occurred. What you see, despite the falling discount rates through 2017, the interesting thing is the capital markets have been so strong that the funded statuses remain relatively flat. And I want you to remember that number on the right-hand side of 84.3, because that is where the average plan was as of September 2017. And we'll come back to that at the end of the presentation today. Now what I'd like to do is I'd like to turn it over to Kelly to take us through the highlights of this year's survey.
Great. Thank you, Brad, and thank you, everyone, for joining us today and for those that participated in our survey. Before I turn to the actual results of the survey, I wanted to provide you with some background with regards to the makeup of the survey. Here you will see that this was NEPC's 7th annual survey, and we were very happy to have 143 defined benefit plan sponsors participate, which is a very robust number. Defined benefit trends are a key topic on people's minds, so we were very pleased with the response rate. This sample size consisted of $169 billion in pension assets, which consisted of a similar breakout between large plans and small plans as shown by the top right chart, and this is consistent with what we've seen over the previous 2 years. The respondent universe was also diversely distributed amongst organizational types. As you can see by the bottom right chart, the majority of respondents were corporate plans, but consistent with past years, a quarter of the respondents were healthcare sponsors, as they are increasingly focused on this area. As we look through the responses, the survey captured a diverse range of plans with different benefit formulas, such as final average pay, career average pay, and cash balance plans. We are very comfortable with the results of the survey given the diversification of plan size, organizational types, as well as the amount of assets captured in the survey. Importantly, we think this survey captures the industry as a whole. When compiling the results, we compare them to what we see across NEPC's client base to determine if they are reasonable. But it is important to note that of the respondents, only 28% were NEPC clients, so we are confident this survey represents the trends of the overall industry. Some of the charts illustrated today compare the survey results year over year, like this chart displayed here. For these charts, we will be showing current data in the darker green and 2016 data in the lighter green. In addition, throughout the presentation, some of the charts will compare the corporate results to healthcare results. Corporate will be shown in dark blue, and healthcare will be shown in light brown. So with regards to plan status, as shown here, we haven't really seen much change with the percentage of plans that are open, closed, or frozen. The results over the past few years have really been divided amongst a third to each of these areas as indicated here. However, we do note a slight drop in the number of plans that are frozen, going from 41% to 38%, as shown on the right-hand side of this chart. And as we look through the data, the drop in plans that are frozen is really being driven by the healthcare responses. Last year, 25% of healthcare plans that participated in our survey indicated that they were planning a planned termination, and we think that could be a partial reason for the drop of frozen statuses out of the survey. We don't expect many changes in the future to plan status as we continue to ask those plans that are open today if they plan on remaining open in the foreseeable future. Last year, 71% said they will continue to offer an active defined benefit plan in the future as they believe either their plans attract employee talent or that the plan's funded status risks are being managed. This year, that number actually increased to 80%, which indicates to us that the percentage of open plans is likely to be similar in the future. We continue to see plan sponsors reduce their rate of return. This year, we saw a 5% increase in plans with a rate of return equal or less than 7%, is illustrated by the left-hand side of this chart. We think this is a result of plans continuing to adopt liability-driven investing, moving further along their glide paths as funded ratios have improved, and also a result of the market environment as bond yields remain low and the recent strong equity market has borrowed from future returns. As Brad mentioned earlier, funded ratios have increased significantly based on the data in the marketplace. The respondents in NEPC's survey have also experienced a similar increase in funded status. Last year, there were 9% of plans overfunded, noted by funded ratios above 101%, as shown by the right-hand side of this chart. This year, that number increased by 10% for a total of 19% of respondents with a funded status above 101%. This was one of the biggest trends we witnessed in the survey this year. We think a couple factors influenced funded status improvement. The first being that in 2016, so last year's survey, a quarter of plans with a funded status below 100% indicated that they were considering additional contributions. This is not surprising to us as funding additional contributions can offset the higher PBGC premiums over time. In addition, these plans with over 101% funded statuses, 61% of those plans were either open or closed, which indicates that they had higher allocations to risk assets to benefit from the recent market improvements. And lastly, we observed that 55% of these plans with improved funded ratios still utilize LDI, but in a more efficient manner through derivatives, again, allowing those plans to deploy more capital to risk assets. Liability-driven investing, or LDI, has been a big discussion point amongst plan sponsors over the last 11 years with the adoption of the Pension Protection Act. And while it may not be appropriate for all plans given unique goals and objectives, we continue to be interested in the views of plan sponsors regarding this topic. With that, we asked plan sponsors if they are currently utilizing LDI, and this chart breaks out the responses by healthcare in light brown and corporate in dark blue. And the majority of respondents said yes, they are utilizing LDI strategies, as you can see by the 59% utilized by corporates and 56% utilized by healthcare. This trend has been pretty consistent in that a majority of respondents have used LDI since we issued this survey in 2011. However, there were a couple differences in how organizations are considering LDI now. For example, this year, 12% of corporate respondents indicated they were considering LDI now, which is up from 4% last year. And this increase was not really surprising to us given the improvement in funded ratios. These plan sponsors are now evaluating locking in their funded status gains. On the other hand, 9% of healthcare respondents are considering LDI this year, which is actually a 12% decrease from last year's survey. And these plan sponsors cited concerns around the low interest rate environment and also waiting for interest rates to rise. LDI is not appropriate for everyone, as shown by the 30% of corporate plans and 34% of healthcare plans that are not pursuing LDI today. When we ask these plan sponsors for the reasons why they are not considering LDI, interest rate levels and plan status were the two most cited reasons. But what was interesting to us is we saw a reduction in corporate plans waiting for rates to rise, as shown by the 27% going down to 23% in 2017, whereas on the healthcare side, we actually saw an increase on the dependence of rising rates, going from 45% to 62%. At NEPC, we certainly do still see a number of clients utilizing a total return approach, and given that 80% of open plans today expect to remain open for the foreseeable future, we anticipate that a number of plan sponsors will continue to reject LDI. For those plan sponsors that employ LDI, we asked a number of questions, the first being, what is your allocation to LDI? 37% of respondents had an allocation of 50% or more to LDI, which represents a 28% increase since we started the survey in 2011, as shown on the right-hand side of this chart. We continue to see plan sponsors use LDI, and a number of them have increased their allocations and interest rate hedge ratios over time. Another interesting finding from this year's survey is how LDI is being implemented. We asked respondents to check off all the instruments they utilize in their portfolio, and this chart shows a number of asset classes available. We compared this year's results to our 2012 results when the question was first asked, and we note three trends. The first is that plan sponsors continue to use a diversified approach to LDI implementation, and a number of respondents use a combination of the asset classes shown here. Traditional physical bonds, such as long credit and long government credit, remain the preferred approaches when implementing a core LDI strategy. Secondly, we have seen a significant increase in plans using Treasury-based instruments like Treasury strips, which have increased from 10% at the start of the survey to 37% today, is shown by the left-hand side of this chart. Plan sponsors that have an allocation to Treasury strips benefited in 2017 as less capital is required to hedge interest rates, which frees up assets to invest in return-seeking investments which have performed well. And lastly, custom-based approaches continue to grow. These strategies are utilized by well-funded plans as they attempt to more closely match their assets to the characteristics of their plan liabilities, as shown on the right. We also asked plan sponsors that currently use LDI what their biggest concerns were. Consistent with last year, there were 3 areas that worried plan sponsors as highlighted on the right by the blue and red bars: timing around duration extension, legislative or actuarial changes to valuations, and the impact to total return. Basis risk was also a concern, but less so. However, as you see by the levels of the blue and red, these concerns were not dramatic. The item that generated the most concern, though, as shown in red, was the impact on return when implementing LDI. This differs from last year's results as legislative and actuarial changes were cited as the largest concern. This is not surprising to us as we continue to counsel clients about the potential for a low return environment given current bond yields and elevated equity valuations. I will now turn it over to Kevin to provide an overview of LDI implementation through the use of glide paths, what plan sponsors are considering in terms of alternative de-risking strategies, as well as the usage of alternative and passive investment strategies.
Thanks, Kelly. So I'll begin with the results we observed with respect to glide paths, then review the use of de-risking strategies, and then wrap up with some of our brief observations on the use of alternatives and passive investment strategies. So first we have glide paths. The initial observation we want to share with you is that glide path utilization actually decreased year over year for our total pool of respondents. We noted that the decrease in plan sponsors maintaining a glide path went from 52% in 2016 to 46% in 2017. However, to provide you with some longer-term context, we noted in our first survey, which we conducted back in 2011, that only 27% of respondents indicated they utilized a glide path. So certainly a significant increase, almost double over the past 6 years. We also broke these results out by plan types, and as you see on the top chart on slide 25, that the year-over-year decrease was actually driven by corporate plans and not necessarily healthcare. On the corporate side, we observed a decrease from 54% to 42%. And what's interesting is that roughly half of those corporate plans that do not use a glide path have no plans to implement one. And what I think is even more interesting is the fact that 42% of those corporate plans that do not plan to implement have funded ratios above 95%. Now, these results differ pretty dramatically from their healthcare counterparts in that we actually observed an 8% increase in glide path utilization since 2016. And you see at the chart on the bottom an increase from 51% last year to 59% this year. One characteristic we found interesting from those healthcare organizations that do utilize a glide path is that 70% of them have a funded status below 95%. Now, despite the fact that we broadly observed a decrease in the use of glide paths, for the 46% that do utilize glide paths, we continue to see that they remain active in terms of formally reviewing those glide paths. Although we observed a slight decrease year over year, a significant majority, and we have noted 70% on the slide, formally reviewed their glide path at some point over the prior year. And what's more, that level of review is actually translating into changes in established glide paths. And as you can see on the chart, we did observe that nearly half of respondents elected to make changes to their glide path. Specifically, we saw that 35% modified future trigger points, while 12% of plan sponsors actually re-risked their portfolios. And these numbers represent a pretty significant increase in activity from the prior year, as you can see. One interesting point I'll make is that of the 12% of plan sponsors that did re-risk their portfolios, 75% had a funded status below 90%. Now, we did observe that plan sponsors remained active in terms of reviewing and making changes to their glide path, but what about actually moving along that glide path and hitting the triggers that have been established, especially after a year in which global capital markets rallied and we saw an increase in funded ratios, as Kelly discussed earlier. In our 2017 results, we saw a notable increase, double actually, in plans that hit a trigger in 2017. But the most interesting data point we gathered from this portion of the survey was that of those plans that hit a trigger, 18% indicated that the trigger was caused by a significant plan contribution, as opposed to what's occurred in the markets over the past year. One final note I'll make on before closing out on glide paths is that for those plans that hit a trigger in 2017, 94% actually took action and moved along their glide path. That's certainly a different story from our 2016 survey, where we noted that 67% of those plans that hit a trigger over the prior year actually delayed taking action due to their view on interest rates, presumably waiting for interest rates to rise before taking action. Now, there's a handful of common de-risking strategies that we've observed plan sponsors engaging in to attempt to lower the risk associated with managing their pension plans. Within the next few slides, we've illustrated how these strategies have been utilized and then how our most recent results compare to the prior year. What I think you'll notice at a high level is that plan sponsors have been active in their consideration of these de-risking options, as we'll see that represented by the presence of yellow bars in the following results. But you'll also notice that the actual use of these traditional de-risking strategies has declined slightly over the past year. On page 30, we have two of the most common de-risking strategies we see utilized in the marketplace: lump sums, and in just a minute I'll talk about annuity buyouts. But in the top chart on lump sums, you see that they continue to be the most utilized method of liability reduction strategies, with about 65% or so of respondents indicating that they have implemented the strategy in 2017. With that said, we did observe a slight decrease in those plan sponsors either planning or having implemented lump sums year over year. And we specifically note here that there was a 12% decrease year over year. Annuity buyout implementation was fairly steady year over year, although we do note the increase in those that considered but rejected the strategy. But where we did see a meaningful change was with those planning future buyouts. And you can see on the chart that those planning dropped from 28% in 2016 to 18% in 2017, or we have noted there a 10% decrease. On page 31, we have terminations, where we did see a decrease in plan sponsors that were either planning or implemented the strategy. We also looked at annuity buy-ins, where an annuity is essentially purchased on a portion of the plan's outstanding liabilities, but still remains in the plan. We did not observe a material change with annuity buy-ins year over year. And perhaps just to wrap up on page 32 with hibernation strategies, which, as a reminder, are those strategies that look to minimize surplus risk by very closely matching assets with liabilities. In 2017, we did observe a meaningful decrease in the implementation of hibernation strategies. The 4% we observed in 2017 is actually more on par with our historical findings from the survey, but it is certainly a significantly lower than the pop that we experienced in 2016, where we observed 11% implementation rate among respondents. Now, I did mention that in general, we observed a decline in the use of the de-risking strategies that I just discussed. However, we have observed an increase in other approaches by plan sponsors to close their unfunded gap, including higher contributions and issuing debt. And one of the catalysts for these other approaches is the recent increase in PBGC rate premiums that plan sponsors will be subject to. When asked if plan sponsors were planning any changes to strategy in the next 6 months due to the increase in premiums, 80% indicated they will make some type of change. Based on the results we've compiled, partial risk transfer, as you can see, is clearly top of mind for plan sponsors, and nearly 1 out of 4 respondents indicated they would make higher contributions. We did notice that after being the most popular strategy in 2016, lump sum payouts dropped pretty significantly in 2017 and was the least considered option. Thinking about it, we aren't necessarily surprised by the drop in lump sum activity, given the rush over the past few years from plan sponsors to offer lump sums ahead of mortality table changes. And based on these results, it appears that those that were considering lump sums over the past few years have gone ahead and implemented. One additional approach to closing the unfunded gap that we first introduced to the survey last year is the notion of issuing debt as a means to make additional contributions to funded status. In 2016, we observed that 34% indicated that they had either considered or planned to issue debt for this purpose. That figure increased to 40% in our 2017 survey. Perhaps I'll mention just a couple of additional findings about that 40%. First, 80% of these plans have already implemented or are planning to issue lump sum payouts. And second, over half of the respondents planning on issuing debt have a funded status less than 80%. Now, those figures are for our total survey results. We also observed a few differences between corporate and healthcare respondents, as detailed on the chart at the bottom of page 34. Clearly, healthcare organizations have been more inclined to consider and or actually issue debt for this purpose. From the healthcare perspective, we've observed a significant increase in organizations that are actually planning on issuing debt. And that 10% figure you see on page 34, it's actually a five-fold increase from last year's survey, where only 2% of healthcare organizations planned on issuing debt. I think what's also interesting and actually makes a lot of sense to us is that all of those organizations included in the 10% maintain funded ratios of less than 80% on the healthcare side, whereas when you look at corporate-specific plans, only about 50% have funded ratios of less than 80%. Now I'll go ahead and wrap up with a few observations with respect to the use of alternatives and passive strategies. Overall, the use of alternative investment strategies like private equity, hedge funds, and real estate remains prevalent in pension plans, with 77% utilizing these investments. As you can see in the graph on the left-hand side of the page, roughly 45% of respondents maintain an allocation to alternatives of at least 10% of total plan assets. And those results are similar to what we've seen in our past surveys. What's also consistent with our prior survey is the fact that expectations for the use of alternatives on a forward-looking basis is roughly the same. And you see that 79% expect to maintain a similar exposure, or roughly the same amount, and roughly the same amount expecting to increase as decrease their allocations to alternatives. And finally, we included a new question in this year's survey surrounding the use of passive investment strategies in pension plans. Our findings indicate, not surprisingly, that 90% of respondents utilize some form of passive strategies in their portfolios, and 40% actually have allocated more than 25% to passive investments. What's particularly interesting is the chart on the right side of the page, which indicates that the use of passive strategy is expected to grow over the next 12 months, as we see 10% expect to increase their allocation, while only 4% expect to decrease. So that's an overview of our findings for this year's survey. At this point, I'll go ahead and turn it back over to Brad to wrap up.
Okay, thank you, Kevin. I see 2 yellow sticky notes over there, so I know we have a couple of questions. Just a reminder that you can submit a question at this time using the Q&A function on the lower right-hand side. Kelly, do you want to read the first question, please?
Great. So the first question is, what about the survey results surprised NEPC the most this year?
Well, so as I look at the data, I don't think it was any of the trends. I think it was the data point with regard to the number of plans that are over 101%. I think that rose from 9 to 19%. A number of plans, or I guess a lot of providers out there track the average funded status, and I've seen anywhere from 84 to 87%. So just seeing that number be as high as it was really surprised us. As I look back at client activity, that Bipartisan Budget Act of 2015 still continues to drive a lot of activity in the committee meetings we're working with. That increase in the variable rate premium is a real tax, and it's a big number for a lot of plan sponsors. So I guess I'm not surprised, but I would say that data point really was kind of an outlier. I wasn't expecting it.
Okay, great. The second question we have here is, the survey mentions alternatives broadly. Can NEPC comment on the usage of hedge funds specifically?
Yeah, I kind of was afraid that topic would come up. So every year when we do this survey, we try to balance new questions with what we've asked in the past to try to capture data. This year we decided to consolidate all of the alternative questions in a single bucket. So let me try to answer it anecdotally. So in our client base, I'd bucket plan sponsors that use hedge funds into 2 categories: those that are using fund-to-funds and those that are using directs. We've definitely seen clients that utilize fund-to-funds decreasing their allocation. Now they're decreasing their allocation by either going back into long-only equities, or they're going into directs. We've seen a lot of consolidation in the fund-to-fund industry. I think Aurora tried to merge with Northern Trust and it didn't work out. Investors didn't sign the consent forms and they actually ended up shutting it down. I believe they're in the process of returning capital to investors. So I would say the trend is not good for hedge fund to funds. But on the other side, we've seen a number of clients build out direct programs over the past year or two. But they're doing it a little bit differently. I'd say about 5 years ago when we were building these direct programs, we were seeing clients build diversified portfolios of 12 to 14 direct hedge fund strategies. And now it's very common to see very targeted direct hedge fund programs of 5 or 6 direct strategies that are really taking specific investment themes and thesis as opposed to a really broad allocation. Looks like we got one more question that just came in.
Yep. So what about the survey results surprised NEPC the most with regards to healthcare plans? So not overall, but healthcare.
Actually, I think I better turn that over to Kevin and let him answer that. Kevin?
No problem. No problem. So when looking at the results, actually I think it's not necessarily a trend per se, but one of the more surprising findings for healthcare specific respondents related to that bullish sentiment that Brad mentioned at the beginning of the webinar. Our findings at the total level were that 54% were bullish on the stock market, but if you look at healthcare specific, that number is actually up to 62% that are actually bullish on the market. And that's roughly in line with the results that we saw over the prior years. So I think that partially explains why healthcare plans have been a bit more reluctant to consider LDI. I guess that and the fact that, as Kelly indicated, that they are waiting for rates to rise before making further commitments to LDI.
Great. Thank you, Kevin. So that's all the questions that we have. Brad, would you like to wrap it up?
Yeah, so just to remind everybody, what we presented today was an overview of the trends. We tried to pull out what we thought were some of the more interesting data points. For those of you that filled out the survey, we thank you very much. You will also notice that there's a lot of data points that we didn't cover. So if you want the long version of the study, please reach out to one of the people listed on the bottom of page 38. If you're a corporate, reach out to Kelly or myself. If you're a healthcare, please reach out to Kevin or Dave Moore. But we want to thank everybody who showed up today. We also want to thank those who filled out the survey, and we look forward to speaking with you again this time next year. Thank you very much. Have a great day.